Welcome to our capital markets panel, arguably the most fun panel we have. I'm a little biased, I think, where we will get some great capital market insights from our partners here from PIMCO, Fidelity, and AB. It leads us into the first question that I have for everyone, and that's really interest rates and the Fed. And I think everybody's, what's the Fed doing? And the Fed has been pretty good at moving the markets, right? Where are they going? And I think the market hinges on what is the Fed doing next. And so my first question to the panel here is, how do interest rates play in the markets for positioning for the portfolio managers? What is the Fed going to do? Is that something that you guys handicap? I think last year it was, about 4, maybe even 6 rate cuts. Every summit we've had, I think that's come down by 1 with the panel. Now I think we're maybe almost close to 0 maybe. I think maybe 2 is the consensus, I don't know, but where's your firm of consensus? And again, how does that play with regards to portfolio positioning and how you guys run portfolios? So Anu, maybe we'll start with you at the end there.
Sure, Jeff. So Fed is certainly the 800-pound gorilla in the room, so good place to start for sure. So in terms of where we are with the consensus, I would say that the consensus is now with us. We had never expected 6 rate cuts, and now the consensus doesn't expect that as well. So I think right now the expectation is for about 0 to 1 rate cut. And in fact, I probably won't be surprised if we start to hear some whispers about maybe potentially 1 more rate hike. Now, of course, that's not the base case right now. The jury's still out. We'll still be watching very closely the next few inflation prints. But right now, the expectation is 0 to 1 rate cut this year. Now, in terms of why that is the case, well, I think the Fed is staring at a juxtaposition of high inflation or sticky inflation and strong labor market. Both the mandates, which essentially do not give the Fed the opportunity or that opening in the window to put their put to work. So right now, 0 to 1 rate cuts. In terms of how that impacts markets, well, let's start with the equity markets. So equities are really nothing but present value of future cash flows. Now, if those rates are higher, that means those cash flows should be valued lower. However, if those cash flows are rising at a pace faster than the rise in interest rates, then there is a case to be made that equities could still continue to grind higher. And right now, that is pretty much the expectation. Equities could continue to rise higher in 2024, maybe even 2025, who knows, but because earnings are expected to grow. Earnings are expected to grow about 10 to 11% in 2024, about 13 to 14% in 2025. So that is still a very, very reasonable, very constructive backdrop for equities. Turning to fixed income, well, fixed income is really very interesting right now. And the reason for that, or the case for fixed income, all you really need to do is go back to the very academic reason for why you own fixed income. Generate income, and when the debt matures, you get your capital back. And pretty much you can check both the boxes today. You can get good income in fixed income, and hopefully the US government doesn't default on its debt. If the economy stays strong, likely most other issuers of debt meet those debt obligations when those debt matures. In other words, defaults don't rise tremendously. So fixed income, really a very simple story of generating income, clipping coupon today. Not a whole lot of value in fixed income, I would say, because for the most part, it is still priced quite richly, but you're generating good income in fixed income. One other comment I will say is take a very close look at those 60-40 portfolios. Because the basic premise or the basic design of 60-40 was that when one yins, the other yangs. Unfortunately, right now, with inflation where it is, the 60 and the 40, or the stocks and bonds, are positively correlated. So what does that mean? Is 60-40 dead? I do not think so. I don't think 60-40 is dead. I do think that it needs to get enhanced with something else, an alternative source of alpha that is less correlated or uncorrelated to the 60 and the 40.
So thank you. You mentioned in there rate hike, which, I started, wow, we were talking about the number of rate cuts. I mean, are there any probabilities that would turn everything upside down, right?
Well, as I said, that is most certainly not the base case. That is not something that the market is pricing in right now. But having said that, if you go back in history, has happened before. Back in the 60s, the Fed started to cut rates too soon. Again, back in the 70s as well, in the Adam Burns era. Fed started to cut rates too soon. Inflation started to rise again, and then the Fed had to step in again. That's one of the reasons why the Fed is being so cautious this time, just because they do not want to repeat the mistakes of the past. Having said that, where inflation is going right now, and where we're starting to see these parts of the economy that were cyclical, that were somewhat suppressed in the last 1.5 years, they've started to rebound again. What that means is, well, we could start to see inflationary pressures come back again. And if that happens, who knows, we might be looking at another rate hike.
All right, wow. Well, so we have come a long way since San Diego in the first summit. So a not so small bond shop, Rich, your thoughts, PIMCO's thoughts on inflation. Are you guys the consensus?
We've been below consensus for quite some time. So if you take a step back, and you only have to go back 6 months, so we're not talking far. If you remember that the 10-year Treasury is trading around right at 5%, and right around that time, markets came out and said that's when the Fed was going to cut 6-7 times this year, right? And then all of a sudden, you saw the 10-year drop from 5 below 4 quickly. During that time frame, we were sitting in the camp of below consensus still, right? And a lot of it was because of the inflation piece of it there. One element I'll kind of share as it relates to inflation and why you might see it remain a little bit stickier, why it has been sticky for quite some time. Think about the environment that we had even a few years ago, right? Coming out of COVID, we see this big injection of capital in the markets with monetary and fiscal policy, right, to the likes we haven't seen, right? But you think of it too, we were in a near zero rate environment in terms of that. So think of the homeowner to start off with, all of us in here. I guess I'll throw it out to the group. If you look at 30-year mortgages in the US, what percentage of those mortgages are below 3%? Anyone throw a number? I'll throw it. It's over 90 is the number.
Yeah.
So you think about that. If you're a homeowner and you're probably one of your biggest pieces of debt, right, and your cash flow has not changed, and even though prices go up, you're still able to go to Taylor Swift concerts, right, and across the U.S., right, she brought in a lot of money. So you think of that, and right, that still persists out there from the standpoint. But now you kind of fast forward to today's environment. I would tell you that from our view is we're still below consensus. We're kind of in that 0 to 1 camp. I think I've seen more 1 to 2 is what consensus is out there. I would say we've even starting to say is the pivot we were thinking might be June. The pivot actually might be December, right? So even pushed further out. And pivot might not necessarily be a change in rate cuts coming down, but a pivot might just be a change in language of saying we might start easing things up. So that's where we're at right now.
All right, well, thanks. So pretty close here. From the bond folks, on the equity side, big equity shop, thoughts on rates and implications for the markets? Great.
We're pretty much at consensus, 0 to 1, December. There is that who knows what, as some of the open, what's funny, you think about open market operations, remember that term years ago, now there's open mouth operations. So that forward guidance or some of the words that's actually used, and you think of AI, like really peeling back the onion, what was actually said, what does that mean for everybody? Like going forward, that's gonna be picked apart. So we're definitely looking at that. You think about further into just fixed income and how we're thinking of positioning at AB, because about half our assets is in fixed income, then I'll pivot to the equity side. And you think about high yield right now and yield to worst is a great predictor of 5-year forward returns. So if you're looking at high yield right now, it's about 7%. That's not a bad place to be, you think about. In high yield, obviously you want to be selective in that. You think about even munis could be interesting as well. Equity side, I'll get back to that. So 2 of our analysts for the AB Large Cap Growth portfolios sit about a mile this way from us too, and I love picking their brains about what's going on and what do we think about equities right now. And you think about what different attributes could be pretty solid in this market environment. So quality balance sheets is probably something you've heard before, right? Quality this. Nobody's gonna say we buy non-quality companies, right? You think about high quality balance sheets, you think about return on assets, return on invested capital, return on equity, interest coverage if you're looking at small cap securities as well. But equity side, quality is a theme all across the cap spectrum, is that what we're looking at. And when it comes to the Fed funds and you think about this inverted environment that we're in from the yield curve perspective, we're thinking 0 to 1, but it keeps changing. To your point, over a 2-week span, it changed from like 2 to 3 to 2, now we're like 0 to 1 maybe. It's pretty interesting for sure.
All right, so you're all fairly in that range. The concert picks were a lot more different, diverse than the consensus here now on rates. All right, well, interesting. We'll see what happens there. Like you said, it's always changing. So no one can predict the future. So to navigate, so let's go to another topic that is more of a philosophical one, and that's active versus passive. Active investing versus just indexing. And I know in our industry, index seems like the easy button, right? We're covered as a fiduciary, let's go index, low fee, that's it, right? That's it, that's the easy button. But a lot of value to be had in active. You know, we're talking about rates, navigating rates, high yield, right? I mean, equities. So thoughts on active versus index over the next 5 to 10 years, and maybe, you know, where are some of the better places to be if you're active? And so, you know, maybe Rich, will have you start it this time.
Yeah, no surprise. I'll be very biased with this fixed income. Think of it this way, but if I take a step back, I'd say regardless of what asset class you're in, if the underlying money manager consistently drives alpha and risk-adjusted returns all day long, right? I would say from a category standpoint, there are just some inherent advantages for fixed income managers. When you look at fixed income in general, and I'll just focus it on just more the DC kind of focused categories, you know, more than 70% of active bond managers beat their index or even beat the passive consistently. I can break that up over 3-year, 5-year, 10-year rolling periods, doesn't matter. And you think about that's the environment we've been for the last 15 years has been really a low rate environment. Now you kind of fast forward and you look at where we're at today, like the average core plus fixed income manager out there is delivering about 150 basis points of additional starting yield over the benchmark. So 1.5% starting yield higher than a passive, right? I'll let you know, forward-looking returns for fixed income are based on starting yields. That's a very high percentage of it. So as an active fixed income manager, I have a 1.5% head start on everybody else who's passive, right? So there's huge advantages from that standpoint. And I guess the question is, well, why does fixed income have these advantages? Obviously, from a yield standpoint, it gives us some flexibility to be like a little bit out of benchmark. But there's just, when you think of the fixed income landscape, it's slightly different than equity. So equity markets tend to be very efficient, right? If you're trading in an S&P 500, you can argue that a lot of that information is available to everyday folks, right? There's some subtle differences there, but most people have access to the information real time. Fixed income markets are a little different in the sense of, I guess I'll throw this question to the group. How many bonds are in the US Ag index right now? Any guesses? If I said S&P 500, you probably get pretty close to that. But how many are in the Ag? It's over 13,000, and it changes daily, right? So you think about that as you have an index that has over 13,000 holdings into it. Those bonds have finite lives to it. Trading is very active in that space as well, and it's all over the counter, right? So for a passive manager in fixed income, there tend to be some higher costs to replicating an index, right? There's higher costs to trading as well within that. So what happens is from an active and passive manager in fixed income, that spread is pretty tight, relative to maybe some other categories that are out there. So knowing that the costs are pretty similar, knowing that I have some additional advantages. So I would say in this environment looking forward, fixed income you're going to see some pretty good stories coming out of it.
Active fixed income. Yeah, I never got, the ag's done all right, but when you think about index construction methodology, to build your index and to overweight all of the largest debt holders the most, right? You have to kind of question that. Does that make a lot of sense? So thank you, Anu. We'll go to you next.
Sure.
Strategist on the fixed income side. I have a feeling maybe active fixed is your answer, but.
Well, I would say it's not active versus passive. The debate or the conversation has to be active and passive. I think there is space in the room for both. Passive is a good starting point, a good reference point. But remember, passive is beta. You own beta for the very sole purpose of having access to beta. You don't own beta to generate alpha. And philosophically, I like to believe that all of us here in the room, we are in this business to generate alpha. If it was beta that we were after, it defeats the purpose. Our jobs would be taken over by bots. Now, you cannot generate excess return over a benchmark by owning the benchmark. Which asset classes? I think in every single asset class, a good active manager, a very good active manager can generate alpha. However, to Rich's point, there are certain asset classes that lend themselves even better to active. And those are mostly those inefficient asset classes, fixed income for sure, but even within equities, there are asset classes such as international, emerging markets, small cap, mid caps. Those asset classes just generally, if you can find a good active manager in those, they generally tend to do better than the benchmark. Now, one other thing I would also like to talk about is we get all these statistics. The average active manager does not outperform the benchmark over 3, 5, 10 year, whatever time frames, right? Now remember, that is the average, excuse me. So which means there is a left tail and there is a right tail. So what I would encourage you to do is spend some of your expense dollars, some of your risk budget, some of your mind space on getting passive, and then spend most of the remaining on finding an active manager that is to the right of the average. And if you can do that consistently, you can generate alpha in pretty much every asset class.
So both active and index, and in asset allocation, we call that core satellite, the core being the beta,
Yes.
and then the active, or the satellite being the active managers, all right? Greg, final thoughts from an equity shop,
Sure.
Index versus active.
And jumping onto news comments for where some inefficient more asset classes, you think about small caps,
Yeah.
and 40% of small cap companies have negative earnings. So how do you navigate that? And typically there's not as many Wall Street analysts covering small cap companies. So AB would say with small caps, mid caps, definitely active over passive. What we're seeing too, a trend, I think institutionally, the smart money, right? They would say, oh, well, it's super efficient in large caps. Let's just keep it passive. What we're seeing is a trend recently, actually this year and last year, to the tune of about $1 billion active large cap growth mandate from a large Fortune 500 company it went from passive into an active large cap growth mandate, which when you think, hear $1 billion, like what? That's wild, like my 20 years of doing this, but you don't typically hear that, but they see the value of going, especially active in this market environment, and to the tune of another $500 million trade coming in a publicly traded company, same thing, large cap equities. So that notion that institutionally that, oh yeah, just go passive, it's not as efficient, and to New's point too, you could still get that alpha in basically every asset class, we would contend. That's our thoughts.
Well, large cap especially, right? So last year, if you just indexed, especially large cap growth, if you had the Magnificent Seven, that explained the market. That's really where you wanted to be, and that was maybe almost 40% of the index. I think now the Magnificent Seven is the Fabulous Four, right? But so active in large cap, that was a big one to be getting that, and that's just, and you guys have had a lot of success, and we'll get to that in a little bit maybe with regards to how you guys manage money there. Well, thank you for those thoughts, active versus passive. The more important question I had for all of you though was, and I think what we all want to know is it's an election year this year, right? Not only is it an election year, it's a presidential election year. Are we all excited, or is it like what Yogi Berra says, right? Is it deja vu all over again? So are you guys making a call? How does this impact investing for your portfolio managers? Are you guys making a call on who's going to win the election? And if you are, what's your call? And how does this impact the market? So Greg, we'll start with you.
Are you sure you want to?
Let's go.
I thought Rich was going to get it. That's what I was hoping. What's interesting, a lot of asset managers have sliced and diced this data, and if you look at if it's a Democrat in office, presidential office, or Republican in office, you're looking at a 9.2 annualized return, Democrat side, Republican side 9.1%. You're kind of splitting hairs, and you think about the Fed's got a dual mandate, they're doing some other stuff too, but the president gets blamed for so much, almost too much. For example, what we've seen with our data is that as investors, you probably would prefer a divided government. So different House, different Senate, different relative to who's in the presidential suite. So you're looking at the 10% there, but if you look at a unified government, that's about 8% analyzed. And then you think about FDR back 1932, his first term. Obviously, it was a different environment. You think about 1929, what happened, but those 4 years annualized 30%. In the stock market, that's pretty solid. You look at his next 4 years in term or in office, you're looking at negative 6.5%. So it's really what the hand that you're dealt going into office. And if you're, for the note takers out there too, if you think about Hoover had the worst you think about during the Depression, and then the best one was Calvin Coolidge, if you're taking notes for the best market environment. But our thoughts, hey, maybe a divided government, but I'm not really going to say either way what I prefer. But yeah, we would say divided as investors, right?
No call on who's going to win the election.
What, huh?
No. So you guys are thinking it's going to be divided maybe, is that?
Sure.
Or not really making a call?
No.
Okay, all right,
yeah.
all right. Well, let's try again. Anu, how about you?
Well, I'm going to make a call because it is Chicagoland. This is the place you come to take risks, right?
There we go.
So the call, with a fair amount of certainty, is that it is going to be someone who is either in the silent generation or borderline silent generation.
Nice.
Way to hedge.
So one piece of advice that I always give around elections, around political cycles, is vote in the booths, not in your portfolios. Because election outcomes political outcomes have very little, if any, bearing to performance of your portfolios. Now, in terms of what happens in the markets during re-election years, because this is going to be a re-election year, so that's important. The last 13 re-election years have been positive years for the market. So something important to remember, we will not get into why that happens and what's happening with policies around re-election years, but that is an investment trend to keep in mind. Markets are generally colorblind, nonpartisan. So to Rich's point, it doesn't really matter who is in power, what is the partisan combination of the Congress. Markets generally do their thing. Most certainly, markets do like divided governments because nothing much or nothing drastic and dramatic gets done when there's a gridlock. So to that extent, there is somewhat less uncertainty for the markets. But other than that, our portfolio managers, our researchers really do not spend much time in changing their portfolio positioning around election outcomes.
Interesting. I wonder if, an election year, it's just you remove the uncertainty. It's done. Markets can move forward. So no call on divided, red, blue. I think if you mix them, what is it, purple? I'm not sure. No. Okay. All right. So I guess maybe Rich, you can narrow it down for us.
We have
a little more. I think we're taking the funnel cell approach, and now it's up to you. Are you making a call? What are the implications?
No, we're not making. I would say we could put up like Super Bowl squares and figure out who wins in the end. But I'll take a little different twist on just kind of being a presidential election year, and I'll take it from a fixed income perspective, and i.e. the Fed. And what does the Fed typically do in election year? I will tell you, there's a lot of situations where there's a rising rate environment, and there's situations where rates are falling. So what you typically see, and we believe that the Fed is very apolitical, right? They're not going to look at this being an election year, and that means we're not going to do anything. But you can almost take a stance or a viewpoint that say that because they want to make sure it's very visual that they're apolitical, would you look at September as a pivot, right before the election? Maybe not. Would you look at November, 2 days after the election, when there could be a lot of volatility in the markets, to add additional volatility for a pivot? Maybe not. So again, it's like, is it December? Or do you kind of put June back on the table, where June maybe is a change in language with it, right? So, but I would say it's the same exact thing with the equity markets and the fixed income markets. They're really not looking at who's in market. The only maybe peel back a layer would be is if you get one side wins over another. Certain issues are more important to different parties, so maybe certain industries might do better than others, but that's about as close you can get with it.
Red?
Yeah, don't know.
Blue, purple? All right, okay.
I'm in Colorado, we're purple.
We appreciate all of those comments. Now, I do have a question for each one of you related to some of the strategies that we partner with you folks on. The first is, and this is hot off of the press, we are going to be launching a new Core Plus bond CIT, Core Plus 3, and that's going to have Fidelity's total bond strategy run by Fort O'Neill managing it, and some great performance there, outperformed over the latest 1, 3, 5 years, I think by over 100 basis points. I won't say a lot of turbulence going on in the bond markets right now. Why are we doing it? It's maybe not coincidental that there is a large manager out there that is losing its third lieutenant, and that's MetWest, maybe was one of the biggest bond funds from the days. I remember there was a little not disruption, but when Bill Gross left PIMCO, money sort of scattered. So, Anu, maybe just quickly thoughts on that strategy in particular, what we're accessing there with Fort O'Neill's team, which has been quite impressive. Can they keep it up? And there are some differences between the CIT and the mutual fund for the folks that use the mutual fund, maybe just the differences in the structure of the CIT.
So the total bond is really our crown jewel. So it's really great news that you now have access to that in the CIT wrapper. And the reason why the fund has done as well as it has, it really comes down to the people process for the fund. Very, very tenured management team backed by an extremely deep research team. The way the manager runs the portfolio, it is really just staying in his lane. Very consistent, doesn't give you a lot of reasons to discuss the fund over cocktails, doesn't swing for the fences, so duration very close to the benchmark. The portfolio is core plus, so the fund is 80% core, 20% plus, and that's pretty much where he stays with a plus or minus, just a little bit. And that's really how he has been able to consistently outperform. Now, in terms of the difference between the CIT and the mutual fund, not a whole lot. The only difference is that the CIT can go up to 30% in plus versus 20%. But in terms of investment experience for the client, it would be really just the difference is on the margin. And then, of course, the pricing is really attractive within the CIT wrapper.
26 basis points. So, and that's going to be out pretty soon. So, yeah, for those of you, again, I won't say a lot of turbulence going on, but for those of you who have it, something to keep an eye on. I know they're losing their third lieutenant. It got to be like the largest fund, then index-like returns. I think it's probably in the 90th percentile now for the quarter, maybe year to date. So thank you for those comments, and we're excited about that launch of Core Plus 3. Let's value versus growth. We'll get to growth, Greg, in a little bit. Rich, I want to go to you. We really source PIMCO for our small cap value and our international stock CITs. Your equity business, really the PIMCO equity business, the largest part of it's value driven, not so surprisingly from a bond manager, but that's, you have RAE sub-advise that. But speak to, why value, why now? I know a lot of folks, you may have an international fund that's international growth. Why should they even consider maybe having an international value alongside that international growth? Small cap value makes sense along with small cap growth, but that's been a successful franchise.
Yeah, absolutely. And I'll start off by first of all saying thank you to everyone in here supporting us with the international value and the small cap value. We see those numbers, and it's been tremendous for us. So I appreciate that. I think a lot of folks initially say is, why is PIMCO managing my equity value spots? It's you'd see us as one of the largest premier fixed income managers. But we also win a lot of accolades as it relates to our equity shop. That kind of goes under the radar there. So kudos to all of you for picking it up. So thank you. But yeah, in terms of value versus growth, I would kind of similar thoughts on active versus passive. I think they both make sense, especially in a DC portfolio. Usually when one zigs, the other zags with it. But if I was to kind of put forward-looking view on value versus growth, kind of similar comments, right? If you're in an environment that is low interest rates, right? Think about it as if you're a growth-oriented company and you can get cheap debt to keep the doors open, right? You tend to get rewarded, and obviously your valuations from that standpoint look well as well. But if you're in a higher rate environment, it gets a little bit more expensive to keep the doors open. And historically, what you've seen in those type of environments where it's a higher inflation, higher rate environment, value tends to outperform. We saw that in 2022 when you started seeing rates and inflation go up. 23 was kind of a weird one, right? Because you'd had the Magnificent Seven really drive 2/3 of the returns in the markets there. But going forward, again, I think they both make sense in a portfolio. But I think there will be some nice distinct advantages from a value standpoint. And then also too, I would say when you look at pure valuations of value right now, They call it basically a 96th percentile, or excuse me, 94th percentile, meaning that only 6% times in history has value been as cheap as this. And so the portfolios that we run for all of you with research affiliates tend to have this reversion to the mean as one of its elements. So you think about it, us just getting some reversion to the mean, you have that additional potential alpha built in, stored alpha for all of you as well.
Yeah, when you think about growth, it's just been Magnificent Seven, and so that brings me into, you guys are growth shops, right? Growth shop, right, Greg? So, and you've got two great strategies, large cap growth, which has done well, versus some of that performance being really concentrated, and small cap growth, which has done well. So just, how do you guys do it from that perspective? And then, since there aren't that many options, in large cap growth, I think it was 90% of the large cap growth managers underperformed over the last 5 years. As a fiduciary, is there a fiduciary risk having you guys manage the large growth and the small growth? Or just thoughts on that, on accessing those two strategies and what you guys are doing there?
Sure, from a portfolio, construction standpoint for DC, DV, et cetera, and having both, since we're on a basketball court, right? You think about fantasy basketball or fantasy baseball, name what you want, especially with the Cubs kind of logo right there. Mm-hmm. But you could have maybe a few players from the same team on your team. For example, you think about it in that standpoint, so having two AB portfolios and a lineup of 16 different portfolios, is it really that bad? But from a fiduciary prudence standpoint, we see it a lot, having two or more within the same lineup itself. And they're two distinct teams, so don't worry about overlap or anything like that. The small cap growth portfolio with Samantha Lau, funny enough, her son goes to the University of Chicago just over there. It's the old Quasar fund, they've been doing it for a long time. And then on the large cap growth standpoint too, you think about fiduciary prudence and what the byproduct of their philosophy of having that intersection of reinvestment opportunity as well as profitability, up-down characteristics, and you think information ratio and different attributes like that, they're through the roof. So we think it's fiduciarily prudent to have both in there. A few seconds too long, sorry, Jeff.
No, that was perfect. Well, so great success on both of those strategies, so keep it up. And while you were talking, the clock did run out, which I thought if we had extra time, we'd have questions, but if we had extra time, I wanted another question to ask you guys. I wasn't sure what to ask you. So then where do you go when you don't know what to ask?
You end.
AI, right? So the question I was going to ask you, not going to end yet, from AI, of course, using the letters AB, from Fidelity and PIMCO, how can I invest all our profits in gold shares? Asked it for an investing question. I thought that was funny. That was right? Funnier than the joke, I thought, right? It said gold shares, not Bitcoin. I think we all need to be a little concerned when AI is asking how to invest in gold versus Bitcoin. But in any event, we ran out of time, so you'll have to ask them for their thoughts on that later. I want to thank the panel today for all of their insights into the capital markets, and thank you all.